Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have our weekly strategy roundtable discussion where we go over what happened this week and what to expect in the next few weeks, in the next few months in the market, what strategies work, what strategies do not, what services we offer at Tradespoon, and answer any questions you might have. For those of you who are new, welcome. If this is the first live event, do me a favor, type in first. Always want to welcome new subscribers. This is my brief bio as Executive Vice President, Head of Technology at Options Express. Options Express was an online broker-dealer acquired by Charles Schwab. At some point, the company was worth over $2 billion. Proud of that experience. I want to take this opportunity to say thank you to all the subscribers. Because of you, I'm able to do what I enjoy professionally, managing and trading my own money. I've been doing that for over 15 years, mentoring and teaching subscribers how to trade stock and options. And finally, I have a master's degree in computer science, specializing in statistics and artificial intelligence. Disclosures are very important. Trading stock and options involve risk and not suitable for everyone. If you're new to trading stock and options, please visit optionsclearing.com to understand the risk associated with trading stock and options. I'm not a financial advisor. I'm not registered with FINRA or SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education and information purposes only. All right, before we get into a trading plan, let's talk about market. So what happened this week? We had let's refresh this. I think this is. So we had CPI data on Tuesday. It came in slightly above consensus, right? Core CPI continued to increase. CPI year over year, you can see kind of previous expected not going down as much as everybody hoped for. Then we had a strong retail sales, basically saying that consumer still has money, even though we do have a negative supply of money, right? Supply of money has been negative first time since Great Depression. But nonetheless, there's still money from savings, from stimulus package, enough for to be we are in a consumer-driven economy, right? 75% economy is driven by consumers, and strong retail sales, right? Better than expected. It was negative, expected was 2, and we got 3. Then on Thursday, we got hotter than expected inflation, right? It was negative, it was trending down up until last month, December, and January expectation was 0.4. It actually came in almost twice as much as what everybody anticipated, right? And that's kind of sparked, again, the debate, will the Fed pivot, when will it pivot, you know, and finally today we have leading indicators, right? Leading indicators, not as bad as expected, right? December down 1%. This month it's only down, I think that's the expectation was negative 0.3. It came in 0.3. We have been 10 months of negative leading indicators, which is usually signs of recession looming, where you have 10 months, and you have Q4 was negative earnings growth in S&P 500 companies, and you know, if we have 10 months of leading indicators contracting, most likely we're going to have second quarter of negative quarter earnings growth, and that can, depends who you ask for, 2 quarters of negative growth usually is a sign of recession. So you can see market did pull back after PPI data, not so much as after PPI data, it actually almost turned positive. You have PPI, market was down, rebounded, then Bullard, the Fed, who's always hawkish, he kind of said, well, maybe 50 basis points we're gonna rise. And you know, market didn't like that much. So it did drop, kind of retested the lows. And today the follow through, right, continuation. And after leading indicator, not as worse as everybody expected. Good morning, Joseph, how are you? We do have a rebound. So we are retested, we broke through this week low, right? We made new week lows. We did not break the last week low, right? So last week low stays intact, 297. The question is what's next, right? Well, number one question is still in technology, is this the low, right? This is $1 million question being debated on CNBC, Bloomberg. I ask myself this question almost every day, right? Especially after the breakdown of this downtrend, right? This was a surprise to me. I was wrong. I thought we're not going to break the downtrend, but we did. So the question is $1 million question that I think on everybody's mind: is this the low? I mean, if you are if you're a day trader, right, you're thinking about minutes or hours, maybe it doesn't really matter, right? But if you're holding position overnight, or you're holding position for a couple of days, couple of weeks, it does matter, right? And or especially if you're more of a longer term investor. So usually we have the wide variety, wide range of traders. Somebody started first day, somebody started, been trading for 50 years, somebody's managing $1 million, somebody's managing $1,000. So we have all gamut of traders, right? All gamut of traders. Average trader is, $10,000 portfolio, have a broker dealer account and been doing this for at least, few months or month, usually 1 or 2 years. That's average, profile, but we have extremes on all kinds of. So this should be the number one question, right? Number one question: is this the low? And then everything will follow through, right? Once you have that theory, right, axiom, right, going back to geometry classes, right? You have certain axiom, right? World is, Earth is round, right? Or is it flat, right? From that you can build on other, theories, right? Trading is the same thing. You have to have an axiom, right? You have to have certain axiom that you think this is the right thing, right? And a lot of people thought Earth was flat, right, for many centuries, right? Only then, relatively recently, they realized that this is, round and revolves around, sun versus the other way. Trading is the same thing, right? Once you have this axiom, whether this is yes or no, all the strategies, all the trading decisions will follow through, right? If you don't have this axiom, if you're not sure if the Earth is round or flat, it's very difficult, to do any kind of scientific projects, right? How do you calculate gravity, velocity, just a lot of different, just all the Newtonian physics will probably fall apart if you don't have that first, some kind of an assumption. So trading is the same thing. Is this the low? Because if this is the low, then I'm going to do one type of strategy for one portfolio rebalancing. If this is not the low, then I would do totally different. So let's throw that question in, first answer it, because that's an important question, right? You've seen the data indicator, right? There's a tale of two stories, right? One is the no landing, right? One is a no landing or soft landing, right? What does it mean? That retail numbers are very strong. People are spending, they're filling up their credit cards, so consumers are spending a lot. Unemployment is low, right? Wages are going higher. Consumers are going to continue to consume, right? We live in consumerism, right? That's the ideology. It's all about spending, and that means that the market is going to continue going higher, right? Continue going higher, no landing or soft landing. And those are very strong arguments, right? Dollar had pulled back significantly. Interest rates also pulled back significantly from 52-week highs. So, 30-year mortgages drop. We started, Bitcoin is going up, meme stocks are going up, ARK stocks are going up, 50, 100%, 200%. So, bull rally is on. Bull rally is on. That's no landing or soft landing, and we're gonna, no landing will probably retest 52-week highs. Soft landing, I don't know, will retest 360, right? So that's choice number one, right? And those are the arguments. The hard landing, right? The hard landing guys basically argue. The argument is very simple, right? Yes, everything that soft landing guys are saying is true, but as long as you have an elevated interest rate environment, right, 5%, target Fed rate 5%, as long as this dollar is at multi-year or decade high, right, it's just a matter of time for earnings recession. We have negative GDP in Q4, negative earnings growth in Q4. We're going to have even more negative earnings growth in Q1 and even more negative earnings in Q2, right? Because there's no way to avoid it when all the companies are borrowing, right? Their debt is coming due, and when they restructure their debt, their monthly payments, those cash flow analysis 101, they're going to be much higher. The debt payments are going to be much higher. That means your margin is going to contract, your revenue is going to contract, your cash flow is going to contract, etc., etc. So you have to figure out, are you in hard landing or a soft landing, right? Those are the two scenarios. So just type in yes. If you're in hard landing, you'll say this is not the bottom. If you're soft landing, you say this is the bottom. So is this the low? Just type in yes, this is the low, right? I am soft landing or no landing. Or you say no, I'm in hard landing camp, earnings recession is around the corner. Okay, so yes or no, let's answer those questions. Mark hit lows already. Thank you, Mark. Hit the lows already. Joseph, no. Okay, so we have yes, no, no, no. Okay, anyone else? We have a lot more people. Andre, Bernie, Don, Faye, Joseph, Mark, Michael Scott, T, Bravos, Martin, Mets fan, Debbie, Virus, Logisolve, T-Love. Sorry, some people just register with email as opposed to first name. No. Hardland. Okay. Well, okay, we're in the audience of hard landing. Only one soft landing. Okay. Yeah. So maybe because you've been on my webinars before, or maybe you just have your own opinion. But majority of the people say no, which is an outlier, right? Or maybe it depends on the market, right? Because the market is down 1%, so people think. Usually that's what I see, right? The usual kind of the herd mentality is that when the market is down, couple days in a row, and I ask that question, and most people say no, it's not the bottom. But when the market was 2 weeks up, 3 weeks ago I asked the question, at least half of the people said that it's going hard. So it's something to be aware of, right? Part of the trading, you have to keep a journal and write down your thoughts, right? If 3 weeks ago you said no landing, and 2 weeks later you said soft landing, hard landing, you can jump, Earth cannot be flat and it cannot be round, right? You need to have, certain studies, certain experiments being done, certain data to arrive for you to change your opinion. So first step is to keep a journal and analyze your thoughts. Very important to be self-aware. And if you see that every 2 weeks you're changing your opinion, and that's what I see, it's very difficult to trade, right? It's a domino effect, right? You follow in the crowd, and you're very often end up at the end of the line, right? The way dominoes work, you have to be at the beginning of the line, then you can make money. Because if you're constantly at the end of the line, you're the last one to fall, well, then you're just kind of chasing your tail, right? So it's very difficult to trade unless you are staying in one camp. And right now, since January, the soft landing camp is, they're making money, right? You cannot argue with that. They're making a lot of money because they were right and the lows held, right? 12 months prior to that, hard landing, guys were making a lot of money, but because they were right. So obviously, there's a price to pay for the opinion, right? For your beliefs. And that's where risk management comes into place, right? But you have to have an opinion, right? You can be market neutral, right? So my opinion that no, this is not the bottom. Okay, great. So then what do? Do I just sell indiscriminately? Is this the end of this rally? Maybe this is the top, right? Most likely, right? If I have to guess, this is the top. early season is already behind us, right? We already kind of know the CPI and PPI data that trading's probably gonna remain, right? It's not gonna, it's longer inflation, right? It's longer, higher interest rate environment. Fed, based on futures data for expectation, Fed is not going to pivot this year, and the 5% now, instead of 4.75, now it's 5.25 target rate. Somebody is actually raising possibility of 50 basis points, but definitely a higher interest rate environment for longer, right? Higher interest environment for longer. What does that mean? You can see it in the price action of 10-year yield, right? 10-year yield, 2-year yield. 2-year yield is at 52-week high, right? We have 3 weeks of higher highs, which is usually a very bullish pattern. You have 10-year yield, 2 weeks of higher highs, very bullish pattern, and you have a dollar, 3 weeks of higher highs, almost retesting 405 level, which is very bullish patterns. What does it mean for technology? If I have to guess, we're coming to an end of this rally, right? Or the best part of the rally is behind us. Maybe we'll revisit July highs, right? I'm not sure what would be the catalyst of that, except that just, bears already been squeezed, right? Bears already been squeezed. Whoever wanted to close their bearish position already did that. If you look at the sentiment, we are reaching extreme levels of bullish sentiment, right? This is a bearish percentage of bears. Bears just, give up their position, right? December was one of the worst months on record. Very extreme bearishness. Now we are on the opposite side of the spectrum, extreme bullishness. We haven't been at these levels since April, since March of last year. So extreme bullishness, and we know what happened in April, in April, big sell-off, right? Big sharp sell-off. So we are reaching those extreme levels where I would say maybe this is the end. Best case scenario is here, right? This is where I would consider sell, right? So if we do jump to this, January high, even if, or we break through this, or we even reach 328, this is where, to me, this is a sell zone. Does the market is going to just fall apart? Not so sure, right? Not so sure, because well, first of all, kind of have my different mindset, right? From seasonality point of view, we are entering a very strong bullish time of the year. Last April we had a big sell-off, right? I also said in April, market is going to rally, and I was wrong, and market sold off, right? So the seasonality, it works more often than not, but it doesn't always work. But the argument that we are coming into strong seasonality, March, April, May, not strong enough to make new highs, but strong enough where market is not going to revisit 52-week low by April, let's say, right? I don't think we're going to revisit this level by April. I don't know what the negative catalyst is going to be. I'm not sure what the positive catalyst is going to be to break through the 330. So that means most likely we're just going to trade in this range, right? Maybe a little lower, maybe a little higher, right? But April, earnings, right? It's all about earnings. In April, right? In the middle of April, we're going to start Q1 earnings, right? And that's the question. Is it negative earnings growth? Or is it positive, right? Expectation that it's negative, and that's when the pullback is going to start, right? That's when the pullback is going to start. But until then, you still have half of February, you have March, you have April. So for the next 2 months, I think the market is trading sideways. What does that mean? Market neutral strategies. If you have stocks, maybe you consider selling calls against them. Right? If you have credit put spreads, maybe just consider selling credit call spreads against them. So butterflies, iron condors, cover calls, selling out of the money premium, especially on the spikes in volatility, that would be the strategy. Any questions? Any questions? So short term, if you're looking at the stock forecast toolbox, Model C's 412 overhead resistance, 407 support. We're trading at, let's see, where's the spiders trading? Spider trading at last week low, right? Friday the 10th. Yeah, so last week low, right? It's peers below that, right? So it's slightly, we'll see where we're going to close. We do have a long weekend. Bulls might, drop some of their positions. If spiders break through this level, right? If today we close below this level and Tuesday we close below this level, then we're heading into a lot of support, right? And that's the bull argument. The bull argument from technical perspective, we broke through, you have a crossover, right, between 250-day moving average, kind of a classical bull signal that shows continuation. You have downtrend, break of a downtrend for a few weeks. 200-day moving average, 50-day moving average, the November November overhead resistance, September low. This is a very important support level for bulls, right? Think of trading as a right, going back to entrenchment, right? Going back to images of for the trenches. Right, so think about these trenches, right? And if it's something recent, there is not a lot of in trenches, right? There's not enough in time to build. These trenches takes time to build, right? It takes months, it takes years. If you got a position, right? If bulls got position and build some trenches, it's very easy to get them out of their position, right? And negative news like leading indicator, PPI down, and then they give up their positions. 200-day moving average, took 200 days to build. Support was since November, a few months. That means bulls build a lot of trenches here. Something negative has to happen to get them out of their trenches, right? It's not gonna happen overnight. So the idea of game theory, right? Trading, it's not enough. Usually when before when I was making the decisions, I was like, okay, the leading indicator is going to going to be worse than expected, market is going to collapse. If PPI jumps, market is going to collapse. Now, I don't think like that, right? One data point, no matter how negative or positive it is not going to make a big difference in overall, game, right? Going back to game theory, you have to figure out who are market participants, what is their mindset, and how easy it is for them to leave their trenches that they have built comfort level, right? Not very easy. Usually, if there is some kind of black swan event, everybody's leaving their positions. But PPI, CPI data, 1 month, 2 months, not a big deal. Leading indicators, 10 months in a row, negative leading indicators, and and market continues to go higher. And why? Because people are stubborn, right? People are stubborn. They build these trenches. They took them a long time, right? They spend a lot of money and sweat. They're not going to just exit at the first sign. So that's how you think about the market, right? You have certain axiom, then you have certain theories, and then you have kind of this entrenched warfare. And the question every time you want to, you think market is going to collapse, just think about, how easy is this for the market to leave those positions, bulls to leave those positions? Probably not that easy. So if I have to guess, we're trading somewhere between 420 and 390, right? Potentially going into the next couple months, right? Kind of something similar to this, right? We spent 2.5 months kind of trading, or, well, actually, if you look at this, so it took 1, 2, 3, in 4 months, we didn't go anywhere, right? And if you expand this, it's even longer. So in 4 months, we're staying at the same level. If I draw this into March, April, May, we could be still having the same conversation, right? Where we're at 400 level. So what does that mean? Market neutral strategy. You cannot be overly bearish where you just go all in. I'm just going to short the market and spend all my money. I don't think you can go all in and spend all your money on bullish positions. You have to assume that in the next 3 to 4 months, we might revisit 390, maybe even 380 level, right? We might revisit 420, maybe even 430 level. So, when the market is above this line, 400 level too far, this is maybe a sell, right? And when it's below, right, 390, 400, maybe this is a buy, right? So that's how I would think about it. Of the expectations for the next few months. I would watch a dollar, right? This is bears are now probably scratching their head. Why is dollar so high? And obviously it's overbought. So in theory it should pull back, right? Pull back and then continue high. But that's bearish for the market. And then same thing with the 2-year yield. You can see it's overdone. You do have a reversal in 2-year and 10-year yield, right? We briefly broke through the December high, right? Speaking of entrenchment, broke through it and then pulling back, right? Pulling back. So market is sitting on the edge, right? If this pullback continues, then then probably this QQQ pullback is also coming to an end. But meanwhile, this is the line in the sand, right? So stock forecast toolbox basically says 407. 406, 407. Let's look at spiders. 406, 407. So we briefly traded below 406, 407 in spiders. So I would, this is 2-week low right now. We're going back to 2-week low, right? And we're basically approaching February low, right? So market is sitting on the edge. So if we trade at this level today and we trade at this level, Tuesday, that will open up the door to retest this downtrend around 402, 400, which I think will hold, right? So you have kind of ABC pattern, right? You have a big pullback, there should be some kind of a relief rally and then retest, right? So I think that's what's going to happen, right? And then market will probably jump back in March and April. Okay. Any questions so far? Leaving market short squeeze, always trying to fight outflows. This is okay. Thank you, Kevin, on the outflows. Market, thank you. Do you like to rely on? Do I like to rely on Fibonacci on indexes? Right. So I do like to look at Fibonacci. It's kind of everybody looks at this, right? Everybody looks at this. So I do it with the dollar, and you can see it's spot on, right? So dollar, Fibonacci retracement. Question was, do I rely on Fibonacci retracement? Well, I do because I have almost on every chart. So dollar, 20-year high is at 115. I don't know if it's 20-year low, probably close to 20-year low. I don't know about 20 years. Well, not 20 years, 10-year low. Let's call it 10-year low, close to 10-year low. So 20-year high, 10-year low, 50% retracement is 100, right? Or 102. Magically, and I probably need to adjust it here, right? Adjust it to the 2018, right? December 2018, where we had a sell-off, right? Fed tried to raise rates. So if you do that, magically, it stopped exactly at 50% retracement. And now, magically, it's going to stop at 62% retracement, probably spend a little bit of time between these Fibonacci retracement. So there are important QQQ, similar idea, right? We broke through the 50% retracement between pandemic low and pandemic high. We touched exactly to the penny, basically, 38% retracement, right? And now we're basically fluctuating. We're trading between 62% retracement and 38% retracement, and for many months, right? And that pattern might continue until either we're going to break above, right? If we break above 315, 332, it opens the door to all-time high from Fibonacci retracement type of perspective. And if we make new lows and we break through this 257 level, it basically opens the door, well, to 160. That's probably exaggerated, but at least pre-pandemic high, right? On February 2020 high, which is 237. So yes, Fibonacci retracement are important. That is pretty much. All right, Kevin, thank you. Kevin is always bearish, so I agree. Okay, so uh, stock forecast toolbox, right? This is a neural network, artificial intelligence model. It doesn't know about PPI, CPI, just looks at the tape, right? Everybody says, do you fight the tape or do you fight the Fed, right? I prefer not to fight the Fed, but a lot of people prefer not to fight the tape, right? And tape is pretty bullish since the beginning of the year. So do you want to fight it? Probably not. So the model sees 400, right? That we're retesting 400 in the next 10 days. Negative bias or neutral bias, slightly negative. And I think model is spot on. And so I would pay attention to the model, and I think it's showing you the right information, right? Slightly negative trend. Worst case scenario will get to 400, 395. Next 10 days, best case scenario will revisit, 413, maybe, 418, the January high. If you zoom out, right, for the next 6 months, if you zoom out, still a negative trend, right? Not as negative as it used to be before, but still negative trend. Model basically says for the months of February, 412, consider it overbought. Potentially, we can revisit 365 in the next couple months. Maybe, right? So I think we will, but by July, right, model basically says by the months of July, we will revisit the lows. And I agree with that, right? So by July, we will revisit the lows. When? I don't know, right? It could be next week, unlikely. More likely it's going to be after the earnings. Assuming there is no black swan event and status quo, and macro and microeconomic data looks similar to what it's been in the past couple months. It will probably happen once the next earnings season, because once the next earnings season starts, and if we do have negative growth and leading indicator is still negative and PPI is still positive, well, then inflation for longer, and then the word recession will reemerge, right? Right now, if you listen to the feeds of Twitter, not a lot of mentioning of the word recession. By end of April, by end of May, I think the R word will reappear. There'll be a spike, and that can convince the bulls to leave their trenches. For now, probably not. All right. Meanwhile, we are trading at session low, right? We are trading at session low, basically retesting almost February low, right? So key support level, are there a lot of trenches being built? Well, for the past 17 days, right? So for the past 17 days, bulls were building their trenches, right? This is the high, January high. This is the February low. Will bulls leave these positions? Probably not. Probably not. I would be, if you're a short-term aggressive trader, I would be a buyer with a tight stop loss, right? Because if it does break through this level, 296, 295, right, then next level would be 288, right? 288. All right. Any questions? Is it the algorithms that makes the market swing? Definitely, I don't know, what is it? 70%, 80% of all the flow are algorithms, and they're pretty simple, right? They look at just what I told you. You can program that, right? You can program it. They have a lot more Vlads. They have army of Vlads and PhDs in physics and mathematics. Everything that I just told you, you can program it, and that's what will drive the market, right? So don't be surprised that you have a big reversal once we do reach 297, right? Because usually that's how it happens. So they do react to the news, right? Yesterday was a perfect example. PPI, nobody cared about PPI. We actually turned positive. But as soon as James Bullard all of a sudden starts speaking, who's not even a voting member of a committee, market just collapsed. Most likely it's not retail investors. Most likely it's not big wealth managers. It's there's a hedge funds that are driven by news, and they say on PPI maybe you put a little less weight, but on James Bullard put a little bit more weight, right? So these moves probably driven by black box, but black box, they have to be flat at the end of the day, so they don't want to they don't want to take too big of an R. So they'll drive it down to the support, but then humans have to get involved if you want to, to leave the trenches. Algos cannot, push them down. I mean, unless they misfire, right? If they misfire and have, too much leverage, then they can do it. But for the most part, they're just trading support resistance levels. All right. Thank you, Kevin. It was an obsolete issues mask position. Yeah, ChatGPT. Pretty soon we're all gonna have ChatGPT trading for us, so we can, drink pina colada in Miami and watch ChatGPT trade on our behalf. Probably not gonna happen in my lifetime, but sooner than later. All right. New stocks you look at from the scanner, or mainly just look at the well-known follow stocks. Do anything based on insiders? I mean, I prefer to trade ETFs. Question was, do I trade stocks or ETFs from scanners? My position that we are trading in the bear market, right? And you heard me say this over and over again. So in the bear market, I think everything is very highly correlated. So it almost doesn't make sense to pick individual stocks. All right, kind of a bold statement. Obviously, when you turn CNBC and Bloomberg, everybody talks about stocks, right? Because these are money managers. They, if they trade ETFs, well, why do I have to pay them 1.5%, of my account value every year? If I can just go to Vanguard and pay, 25 basis points and just invest into ETF, right? So they can't tell you buy QQQ or sell QQQ because it's a conflict of interest. So they say, well, Deere will outperform and JP Morgan will outperform, and trade, invest into value. Everybody says invest into values. Drop your technology in January. That was the most popular opinion, right? Most popular opinion, start buying value stocks and drop your technology, right? If you turn on Bloomberg, prior to January 1, and see what happened. Basically, you would be losing money. On most popular opinion, you would be losing money, but everybody was so bearish on technology, and the technology and high beta outperform, right? So that shows you that, if everybody says something, you have to kind of be very careful with that, right? So picking individual stocks, the most popular was, probably LA Lilly, right? It was very popular, right? You can see what happened to that. Merck, right, was very popular. Also pulled back. So all the darlings of the last cycle kind of, even like Deere, and I mean, it did have a good earnings today, but you can see, it's flat basically. So picking individual stocks in the bear market, I think it's very difficult, almost impossible. You can trade them. So earnings strategy, right? Like today we had earnings on AMAT, right? Earnings on AMAT. I did earnings on AMAT. So I do individual stocks, right? So then usually I do earnings, right? Like AMAT, right? Sold AMAT iron condor. Every week I try to do 1 or 2 examples of how you can do iron condors. Sometimes the trade goes against me. I would have to defend the position, but that goes for any trade. Any trades, sometimes it goes in your favor, sometimes it goes against you. There are different ways to repair your trade and execute repair strategies. Usually with a stock, right? So let's say AMAT would have dropped below 107, I would have shorted the AMAT stock, right? If I do, because I see a pullback, but AMAT did, decent earnings, not going anywhere. Okay. Any other questions? Thank you, Faye. Where do I think TLT is heading? Also $1 million question. So right now, narrative is changing, right? Basically, inflation is higher, CPI, PPI data is higher. Fed probably, at this point, there is almost 0% probability, right? If you look at the futures data, that the Fed will pivot right? The 25 base, 2 or 3 more rate hikes of 25 basis points is already priced in, and then Fed pause. So from that perspective, yes, TLT sold off, right? Because it adjusted to this new PPI and CPI data, but it's not doing this, right? Unless we're going to 10%, right? Unless we're going to 10%, if it's 4.5, 5, 5.25, 5.5, it's not going to do this, right? But it will probably not revisit the interest rates of 2022. We're not in that environment, but we're in an environment where in the next even decade, right? Some already people say, not forget next month or 2 months. If you look at the bond, professionals who spend their money, the research, they're basically say that the 10-year yield is going to be stuck between 2% and call it 5% for next decade, right? Not months, not 2, not 3 decade, right? So for the next decade, if you look at this chart, it's going to look like this, right? We're not going to zero, right? Nobody, the free money, the era of free money is over unless we have another, financial crisis, which is possible in the next decade. Then interest rates will drop to zero, right? But assuming there's no black swan events, right, where Greece doesn't default on its debt or something like that, and that's not a crisis, but I don't know, maybe Germany defaults on its debt, like bigger crisis. Then we just trade in this interest rate environment. So from that perspective, TLT, right, the prices of TLT inversely correlated. I mean, can it revisit this level? Unlikely, but possible. Will it get to 2%? Very likely, right? It's just a question of time. I thought it would be first half of the year, probably not, but I would say by middle of 24, right? By Q1 or Q2 of 24, the interest rate will be 2%. Now the question is why? Is it because of the recession, or is it because of no lending? Right? I don't know. And for TLT, it doesn't matter what the reason is, whether it's a recession or no lending. Interest rates, by end of this year, by early next year, will be at 2%. That means there is a lot of room to the upside in TLT, very little room to the downside. And this is the most favored, most well-advertised trade. I'm in that camp. What is the what would be the counter argument? Hyperinflation, right? PPI went up 0.7. Next month it's 1. Next month it's 1.5. Basically, your inflation data we didn't peak. We thought we peaked, right? We pulled back, and then the resurgence, right? Of this hyperinflation, right? The only reason it can happen if Fed all of a sudden pivots too early. There's no indication of that. So as long as Fed doesn't pivot and as long as the recession is looming, I think hyperinflation is off the table, right? The only reason hyperinflation can resurrect if Fed basically says, you know what, everything looks great, we reached our dual mandate of price stability and low recession and low, low unemployment. We can take a break and go on vacation during summer. We're going to start lowering interest rates. In kind of repeats of 70s and 80s, right? We already had this situation in 70s and 80s, and Fed doesn't want to repeat the makes mistake. That's why hyperinflation, in my mind, is low probability. Is it completely impossible? Low probability. And even if it happens, it's not going to happen in the next couple of months. It's probably going to happen in the next couple of years. At some point, Fed will lower interest rates, maybe even by end of this, not this, but sometime in 24. Sometimes in 24, Fed will start lowering interest rates. Probably, first half or second half of 24, they're going to start lowering interest rate. That it is conceivable that 25, 26 inflation comes back. But we'll have a few more presentation before that, and we have time. Joseph, thank you. Scott, how far out is news baked into a stock? Long LNG moving down, earnings on 223. I mean, there are some studies that, you know, I don't think there's any patterns, right? My opinion, earnings are completely unpredictable. Obviously, there are CEOs, CFOs, obviously they talk to their friends, they have friends in hedge funds, and somehow they get a hold of this news. I get that, but it's not a pattern. It's not something you can just, an average retail investor can determine, right? If you have friends at hedge funds and they specialize in trading Cheniere energy, okay, you have an edge. I agree with that. It's probably you're violating some, you know, SEC rules, but okay, you know, you heard from a friend of a friend, that's fine. But on this broadcast, I don't have any friends that trade Cheniere energy for large hedge funds. It is trading down, most likely not because of, you know, some news. It's just because nobody wants gas, right? We thought Europe is going to freeze to death. They didn't, right? We're approaching the end of the winter. It's, you know, actually it's snowing in Chicago, but it's still probably one of the warm. I came to this country in 1989. So how long has it been? 10, 30, 32, 33 years. I don't remember in 33 years warmer winter than this year, right? And if I ask 1,000 people, they probably, you know, 70% of them will support my opinion. So that is the reason that gas prices are down, right? There's a glut of gas sitting at the shores of Europe, right? That's why the gas is down. That's why LNG is down. So that's probably a better explanation that certain specific news, you know, you can use them to make a prediction about the earnings. And, you know, but again, it's an entrenchment war, right? It's a great company, did pull back a lot. If they have better than expected news, you know, they've done with this inventory better than other people, other oil and gas production, then it will rally, right? If the low gas prices dramatically affected them and it didn't pull back enough, right? It will pull back lower, right? Like today, you look, it's the same idea to me on all of these companies, right? DraftKings is up 15%, Dash is down 5%. Why? Dash is actually had great earnings. You know, more people are eating out, they're ordering, strong consumer, all the numbers look great. Okay, they had some negative news that some write-off, some bad investment, I didn't pay attention. One little bad news, and all of a sudden DoorDash was up, I think, 10% aftermarket, now it's down 5%. Could you predicted this, right? It was going up, you know, you couldn't, right? And DraftKings is up 15%, right? And they're still losing millions of dollars. And I don't know how they're going to refinance the debt, but they're up 15% because, you know, everybody's gambling, right? And we're, you know, country that's, you know, government feeds us into our addictions. So that's great. But so it's up 50%. So can you predict that? I don't think so. I don't really think so, right? I don't think so. You can predict the range, right? You can do iron counter and say, you know, 9 out of 10 times DraftKings, I was selling, I think 30% out of the money calls and puts, right? They had so much premium that 30% of the money called puts, you know, doesn't mean it cannot jump 30%, but there's a lot of premium. Same thing with DoorDash. 20% out of the money puts and calls had a lot of premium. So you can say it's not going to go outside of this range, right? But, you know, it works sometimes, sometimes it doesn't, right? We've had this week was, you know, Devon Energy, right? Devon Energy doesn't move more than 8% basically ever. Not ever, but in the past 10 years. It hasn't moved 8%. But, you know, this time it did, right? It did. Even though, you know, China reopening and, you know, and all these other wonderful news, right? But they're done, right? They're done. Who could have predicted that, right? You know, because the energy is overbought and, you know, and XOP is kind of, you know, falling off the tracks, right? So you have a dual kind of effect. The energy prices, the oil drilling are dropping, and also not a great earnings. So combination of these two macro and microeconomic news pushing the market, pushing the stock beyond what everybody expected. Can you predict that? I mean, I've been doing this very long time. I didn't find the formula. I didn't find the formula, which stock is going to move outside of estimated move. But I know that is a very popular trade. The only reason DraftKings 30% out of the money, because I know there is it's a very popular trade. A lot of retail, especially new traders, they love buying these out of the money calls because they think they can time the market, right? There was yesterday an article, somebody placed exactly $5 million buying 50 calls, right? Strike 50. Right, so somebody bought $5 million of 50 calls that expire in May. Basically, he might have been on my, webinar, and he basically says that by, 23, that we will be at 50 by May. So it's a very popular trade. What I think people don't realize, that probability of that trade to be successful is like winning a lottery. Like literally, you might as well go buy a lottery with the hope that you're gonna make a, hit a jackpot. These are the kind of odds, right, that you have. Right, because it has to be a black swan event, right? It could happen, right? I actually think it might happen, but would I put $5 million bet on this? Maybe if I have $200 million in my account, maybe I would put 5 million. But if I only have 10 million, I would not put $5 million, investment with the idea that I can time the market, because usually 9 out of 10 times you cannot time the market. All right. Thank you, Scott. Humans already doing it to cyber. Thank you, Kevin. Okay, winter could, yeah, usually March could be a little bit colder. Yeah, I agree, Kevin. Scott, great. Okay, thank you, Scott. From what you bond there. Yeah, Kevin, thank you. Yeah, so quantitative tightening, right? Kevin, says don't forget about quantitative tightening, which is a headwind, right? We have a negative money supply, since we haven't had that since Great Depression. And since Great Depression, we haven't had Fed selling off $90 billion worth of debt from their balance sheet, which is, pushing interest rates higher, right? Pushing interest rates higher, and that pattern is going to continue. So very, very point well taken. All right, QQQ is actually trading at session low, right? So it looks like we are at session low and basically retesting this level. So we'll see if that level will hold or not. But yield already start pulling back, so which is good for the market, right? So yields are pulling back, and dollar also pulled back. So we'll probably reach some kind of stability soon. All right, 10:25. Any questions? So in terms of tools and products, we offer a Tradespoon, again, stock forecast toolbox, one of my popular tool. I use it, it feeds signals into active trader, weekly trader, monthly trader, right? So all of our signals with individual stocks, right? This is feed because model does identify certain stocks short term or on a weekly basis cannot perform other stocks, right? Longer term investment, as I said, maybe ETF is better, but if you're doing day trading or short term trading, yes, there's certain stocks like, I don't know, Deere or whatever we have in the past. General Motors, right? So model has been bullish on General Motors, and General Motors has been outperforming, right? It's back to almost, March of 22 high, right? We haven't had these levels since basically February, right? We're back to the same levels we were in February of 2022. So there's something about General Motors that it's, the chart looks better than, Ford, right? So obviously there are exceptions, right? So model is doing a good job picking those signals up. If you do like to trade individual stocks, no problem. I understand, especially if you're a trader, right? It means most likely you're a trader, not an investor, and you can trade anything. So that's your stock forecast toolbox, and then you have active trader, weekly trader, monthly trader that kind of, gives you trade ideas every day and every week, and you can look, healthcare, materials are now outperform. So you can find individual names that are, have momentum behind them. If you want to follow my trades elite circle, you've seen I reference that quite a lot. If you want to see which iron counters I'm selling, or which put spreads I'm selling, or which individual names I'm buying or selling, then elite service. Elite service, I trade on basically almost every day with different services, trade ideas. So elite service. Elite service, you can see my trade anytime, orders, you can see positions, you can type in SMS message. If you're not in front of your computer and I'm closing position, then you'll know it right away. If you're only interested in stocks, we have robo investors. If you only interested in options, we do have spread trader, shadow trader, and premium portfolio. So different services where you get access to my portfolio and SMS messages, different tools. We've covered seasonal chart, we've covered stock forecast toolbox, and pick services. Any questions? What does your screeners allow us to do? So you can go to screeners, and it gives you a list of bullish ideas, right, for the next 50 days. Ralph Lauren, RL, especially if you want a retail name, maybe Ralph Lauren, right? It's obviously outperforming the market, right? It's outperforming the market. It's, what did it start? January, right? It's higher than, it's higher than the start of January. So something about the Ralph Lauren that's okay, then makes sense to think about it, right? Or you can go to monthly trader, right? It also kind of every week gives you ideas. Box, right? There's something about, Box software that it's, it's way higher than December of 21. And then you can research, figure out why, and then maybe it makes sense on pullback to buy it. But be careful, obviously, or it could be the opposite, right? It's approaching the earnings, it might be pullback. But maybe you want to buy this on pullback. Surprises you? I mean, in the bull market, you can definitely outperform the market using individual stocks. In the bear market, you will have hard time outperforming the market using individual names, longer term, right? Longer term. All right, thank you, Faye. Have a good weekend. Scott, thank you. All right, guys, you've been great. Thank you very much. Have a great day. Take some time off, rejuvenate, get some energy back. And Tuesday, Monday we're closed, so Tuesday market is closed on Monday. Tuesday we'll start all over again. Thank you.